The housing market isn't cooling. In a growing number of places, it's cracking under weight that most people don't see until it lands on their chest. Not the slow, polite kind of downturn you can rationalize away with a few optimistic headlines. The kind that changes how banks lend, how employers hire, how cities fund basic services, and how fast a homeowner can go from fine to boxed in. Here's the hard truth. Housing doesn't fail for one reason. It fails when multiple pressures stack at the same time, when the math stops working across the whole system. Payments jump, insurance disappears, taxes rise, wages lag, investors pull back, jobs shift, and suddenly the asset turns into a responsibility you can't refinance, can't sell, and can't comfortably carry. If you own a home, or you want to, you need to understand what's happening beneath the surface. Because the people who get hurt the worst in a housing reset aren't always the reckless ones. They're often the normal people who did what they were told. Buy when you can, build equity, hold long term. That works in stable cycles. It breaks when the cycle changes faster than your mortgage term. Now let's be precise about what this is and what it isn't. This is not a promise that everything will crash everywhere. Housing is local until it isn't. When credit tightens nationally, when insurance markets seize up, when large employers cut or relocate, when municipal budgets strain, local problems start sinking into a national pattern. That's when you get contagion. Fewer qualified buyers, longer listing times, sharper price cuts, and forced sales that reset comps. And forced sales are the engine of every ugly downturn. Not opinions, mechanics. When the market turns, the first sellers are the ones who want to sell. Then come the ones who need to sell. After that come the ones who have to sell. Divorce, job relocation, medical bills, tax liens, insurance cancellations, adjustable rate resets, balloon payments, investors underwater, landlords losing cash flow. Once the have-to sellers show up in volume, the market doesn't negotiate, it reprices. So if you're listening to this and thinking, I'll just wait it out, understand what you're gambling on. You're gambling that 1. Your income stays stable. 2. Your housing costs don't spike. 3. Credit remains accessible. 4. Your local buyer pool remains intact. 5. Insurance remains available at a survivable price. 6. Your city's finances don't degrade. 7. The next few years don't contain any event that forces your hand. That's a lot of ifs for something that is supposed to be the stable base of your life. Let me paint the larger picture. The forces that are combining into what looks in some metro areas like a fast-moving unwind. Force 1. The refinancing cliff. Most people underestimate how much the last cycle depended on cheap refinancing. Refinancing isn't just a convenience. It's a pressure valve. It's how people rolled debt, consolidated payments, funded renovations, and lowered monthly burdens. When rates rise and refinancing shuts down, households lose the ability to rebalance their finances. They're locked into whatever payment structure they have. And if that structure includes resets, interest-only periods ending, balloon terms, or taxes and insurance rising, the math can break quickly. Force 2. Payment shock. Even a good borrower can fail from payment shock. A household that could handle a payment at low rates may not be able to handle it when the payment jumps by 30%, 50%, or more. In some cases, that jump doesn't come from the interest rate alone. It comes from the full stack. Higher taxes from reassessments, higher insurance premiums, higher HOA fees, higher utility costs, and repairs that cost more because labor and materials are expensive. Force 3, investors and the exit door. In many cities, investors became the marginal buyer, meaning the person who sets the price at the edge of the market. When investors are confident, they bid aggressively, offer cash, waive contingencies, and keep prices elevated. When investors get cautious, they don't negotiate, they vanish. That leaves owner-occupants to carry the market. But owner-occupants are payment sensitive and bank dependent. That's how the floor can drop out. Force 4, insurance and climate risk. This one is a silent killer. If insurance becomes unaffordable or unavailable, the home becomes hard to finance. If it becomes hard to finance, your buyer pool collapses. If your buyer pool collapses, prices fall regardless of how nice the property is. In fire corridors, flood zones, storm-prone coastlines, and heat-stressed regions, the insurance market can change faster than homeowners expect. Force 5, municipal strain. Cities run on tax revenue. When commercial property struggles, when offices sit empty, when sales tax softens, when tourism slows, when public costs rise, cities look for money. Property tax adjustments, fees, assessments, and enforcement intensify. That's not politics, that's arithmetic. Force 6, labor market shifts and automation. This isn't about whether AI is good or bad. It's about timing. Housing doesn't care about your beliefs. If a region is overexposed to one industry and that industry reshapes its workforce, the housing market feels it. If high-income jobs thin out, the top-end housing stalls first, then the mid-market, then the rents, then the municipal budget, then the entire local economy tightens. Put those together, and you get a scenario where some places don't drift down, they snap. Now I'm going to do what most people avoid. Name the cities where these pressures can combine into an especially violent reset. Not because those cities are bad, but because they share the same vulnerabilities. High prices relative to income, dependence on narrow industries, heavy investor footprints, rising insurance or environmental stress, and a buyer pool that requires cheap credit to function. You'll notice something else. These aren't minor towns. They're big, influential markets, meaning when they roll over, they drag sentiment and lending standards with them. Here are 15 metros where the downside can be sharp, fast, and personally expensive if you're positioned wrong. 1. San Francisco Bay Area, speculation that ran out of oxygen. The Bay Area became the cleanest example of how innovation and speculation can wear the same outfit. A strong job market and limited buildable land can support high prices, until the job market shifts and remote work changes the geography of talent. When a region's pricing is justified by a concentrated set of high incomes, the housing market becomes less like shelter and more like a stock chart. It doesn't move by inches. It moves by sentiment and liquidity. There are 3 pressure points here. First, tech employment isn't just about headcount. It's about compensation structure. When equity-based compensation gets tighter, or when high-paying roles consolidate, the buyer pool at the top narrows. Second, condo-heavy inventory becomes fragile when demand cools. Condos don't have the same emotional demand as single-family homes. They're more comparable, more substitutable, and more vulnerable to investor exits. Third, municipal strain compounds the pain. When commercial activity softens, offices, retail corridors, downtown foot traffic, the budget pressure flows downhill. And homeowners feel it through taxes, fees, and slower public services. In a major downturn, the Bay Area doesn't just correct. It reprices the entire idea of what a home is worth when the primary driver, high income density, spreads out geographically. 2. New York City, luxury inventory and the cost of running the machine. New York's housing story is two markets living in one zip code. On one side, you have high-end properties treated like financial instruments. On the other, you have normal households trying to survive the cost of living. When the top end weakens, the effect isn't limited to penthouses. It hits the whole ecosystem. Brokers, contractors, building staff, small businesses, tax revenue, and rental dynamics. New York's vulnerabilities. A high share of multi-unit and condo inventory in many neighborhoods. Heavy reliance on finance, media, and professional services. Municipal costs that don't go down just because demand softens. And a buyer pool that is highly sensitive to credit conditions, even when incomes are high. If you own here, the threat isn't only price, it's carrying cost. In a downturn, HOA and building fees can rise as maintenance gets deferred and reserve funds strain. Taxes adjust, financing becomes stricter, and the "I'll just rent it out" fallback becomes less reliable if the rental market softens at the same time. 3. Los Angeles, the dream premium meets real world risk LA is not one market, it's dozens. But as a whole, it's a place where the gap between perception and practicality can get expensive. The headwinds are obvious and non-negotiable. Fire exposure in a huge share of neighborhoods, water stress and infrastructure strain, insurance instability in risk corridors, and an economy that includes entertainment and adjacent industries that can be cyclical and increasingly tech transformed. When insurance gets harder, everything else follows. Buyers who need a mortgage need insurance. If insurers restrict coverage, the buyer pool shrinks. When the buyer pool shrinks, sellers cut. When sellers cut, comps reset. LA also has a lifestyle premium. In strong times, that premium inflates prices beyond what the local income base alone would support. In weak times, lifestyle premiums don't hold their value. Necessities do. Shelter does. Utility does. But poor premium, that's what gets shaved first. 4. Seattle. A high-income market that forgot it was rate sensitive. Seattle rode a wave of tech growth and optimism. But when prices climb far ahead of median incomes, the market becomes extremely sensitive to rates. That's the part people ignore. It isn't enough for a city to have good jobs. Housing requires buyers who can qualify at current rates, not at last decade's rates. Seattle's vulnerabilities. Heavy exposure to a handful of major employers and the broader tech cycle. Condo expansion in certain corridors, and a buyer pool that often uses high leverage to access expensive inventory. In a tightening cycle, the question becomes, how many buyers can still qualify, and how many sellers can still hold? If the answer deteriorates at the same time, you get speed on the way down. 5. Boston, prestige pricing and institutional gravity. Boston's market is powered by education, healthcare, and tech-adjacent industries. That's often stable until it isn't. Institutional economies can create a sense of invincibility. Harvard will always be there. The hospitals will always be there. Biotech will always grow. But housing prices don't need an institution to vanish to get hit. They only need hiring to slow, budgets to tighten, or migration to change. Boston also has older housing stock in many areas. When carrying costs rise, maintenance, condo fees, utilities, older properties can become cash hungry. A homeowner can be equity rich and cash poor at the same time, which is how forced sales happen. 6. Miami. Sunshine, leverage, and the insurance trigger. Miami is one of the most emotionally bought markets in the country. Emotion is powerful in bull markets. It is fragile in bear markets. Here, the main risk isn't just price. It's insurability, financing, and long-term carrying cost. In storm-prone coastal regions, insurance premiums can jump, deductibles can rise, and coverage can narrow. That changes affordability even if the mortgage rate doesn't move. Another factor is investor concentration. In markets with a high share of non-primary residence ownership, you don't have the same "I'll do anything to keep my home" behavior. Investors and second home owners make different decisions. They protect capital. If the math turns negative, they sell. That's how inventory floods and price cuts accelerate. 7. Austin, boomtown dynamics and the hangover. Austin became a symbol of the new American migration. When people pile into a city quickly, especially higher income transplants, prices can rise far beyond what the local wage base supports. That works until job growth slows, tech hiring cools, remote work shifts again, and the city's infrastructure stress becomes visible through daily life. Traffic, utilities, housing quality, taxes, and public services. Austin also saw a wave of investor activity tied to short-term rentals and speculative buying. When regulations tighten or occupancy falls, investor demand can reverse quickly. In a reset scenario, the risk isn't Austin becomes worthless. The risk is that recent buyers who paid peak prices face years of dead money and limited flexibility, especially if they're forced to move. 8. Denver. Lifestyle markets are not immune to the cycle. Denver has strong appeal. Scenery, culture, lifestyle. But lifestyle markets can become overpriced relative to local incomes. When that happens, they rely on continuous inbound migration and healthy credit conditions. When the cycle turns, lifestyle demand doesn't disappear. It becomes more selective. Buyers want discounts. They negotiate. They wait. Add environmental risks, fire corridors, smoke seasons, water constraints, and you have a market where the premium has to justify itself harder every year. 9. Nashville. Growth stories can reverse faster than people expect. Nashville's growth created a narrative of inevitability, but housing markets don't move on narratives forever. They move on household formation, job stability, wages, and lending. If a market sees rapid new construction and rapid price growth at the same time, it can overshoot. Then it becomes vulnerable to any slowdown in demand. The risk in boomtowns is that the market doesn't have a long base of stable, high-income buyers who can buy regardless of rates. When buyers become payment sensitive, price becomes negotiable. When price becomes negotiable, sellers who need to exit become the new comps. 10. Phoenix. Heat, water, and the cost of living in the future. Phoenix is one of the clearest examples of a market where environmental practicality can collide with housing optimism. When you live in extreme heat, you're buying more than a house. You're buying dependence on utilities and infrastructure. If power costs rise, if cooling systems become more expensive, if water constraints tighten, the monthly cost of living can jump, even if the mortgage stays fixed. In a correction, affordability becomes the only story that matters. And in regions where the cost of making life work rises, affordability can compress quickly. 11. Atlanta. Strong growth, but watch the infrastructure and lending. Atlanta has real economic strength and a diversified base compared to some cities on this list. But rapid growth can stress infrastructure, and stressed infrastructure becomes a cost. Time, maintenance, taxes, commuting, insurance in flood-prone areas, and municipal budget strain. Atlanta's bigger risk in a hard downturn scenario is uneven repricing. Certain neighborhoods can hold up, others can reprice sharply. If you buy, assuming the whole metro behaves the same, you can get blindsided. 12. Charlotte. Finance exposure and the vulnerability of stable jobs. Charlotte's identity is tied closely to financial services. That can be a strength, but concentration is always a risk. If an industry modernizes quickly through automation, consolidation, or relocation, the local job market can soften even if the national economy is fine. A finance-heavy market can also become sensitive to credit tightening. When lenders get cautious, it affects buyers directly. Fewer qualified buyers means fewer offers, and fewer offers means price pressure. 13. Orlando. Tourism gravity and investor-heavy neighborhoods. Orlando includes strong, real communities, not just theme parks, but a large portion of housing demand has been influenced by tourism, second homes, and short-term rental economics. If travel demand softens, if regulations tighten, or if investor returns compress, neighborhoods built around that investor demand can flip from hot to oversupplied. Oversupply changes everything. It creates competition among sellers. Competition creates price cuts. Price cuts reset comps. 14. Las Vegas, a market that swings with the cycle. Vegas can rise fast and fall fast. It's historically sensitive to economic cycles, tourism, and consumer confidence. In a downturn, discretionary spending shrinks, job security becomes uncertain, and housing demand weakens. Vegas also has a psychological market component. People move there for a reset, for opportunity, for a new start. In a tight economy, fewer people take that leap. When demand slows and inventory rises, the market can reprice quickly. 15. Portland. Governance strain, migration shifts, and the cost of holding Portland's risks are less about one industry and more about the combined weight of migration patterns, public finance, and livability perceptions, fair or unfair. Housing markets are heavily influenced by what people believe a city will be like to live in for the next decade. Add environmental stress in the broader region. Heat events, smoke seasons, and insurance and maintenance can become larger line items. When monthly costs rise, affordability compresses. When affordability compresses, prices follow. The pattern that ties all 15 together. Different cities, same trap. 1. Prices outran incomes. 2. Credit became the bridge. 3. The bridge got more expensive or weaker. 4. Carrying costs kept rising. 5. Investors started acting like investors again. 6. Job markets shifted faster than homeowners could adapt. 7. Public finance got tighter and the bill landed on residents. That's how a housing asset becomes a housing exposure. Now let's talk about what to do with this, because fear is useless without a plan. If you own, stop thinking like a homeowner and start thinking like a risk manager. A risk manager asks different questions than a hopeful owner. Question 1, how long could you carry your home if your costs rise, not if your income drops? If your costs rise, taxes, insurance, HOA, utilities, maintenance, run the scenario. Question 2, if you had to sell in 90 days, what would you net? Not what Zillow says, not what your neighbor claims, what you would net after price cuts, repairs, closing costs, and concessions in your current market conditions. Question 3, what is your refinance reality? Don't assume refinancing is a universal escape hatch. In a downturn, lenders tighten. Appraisals can come in low. Terms change. The best time to prepare is before you need it. Question 4, Are you insured for the real risk where you live? If you're in a fire corridor, flood-prone area, storm zone, or high heat region, understand deductibles, coverage limits, and renewal risk. Being insured on paper isn't the same as being protected. Question 5. Do you have a mobility plan? If you had to move for work or family, could you rent the place without bleeding cash? Could you sell without writing a check? Could you do either without wrecking your finances? If you're looking to buy rules, not vibes. In a shaky cycle, the best move is rarely rush. It's prepare. Rule 1. Buy payment stability, not maximum house. If you stretch, you remove your margin. Margin is what keeps you alive when the market turns. Rule 2. Respect the full monthly cost. Mortgage is one piece. Taxes, insurance, HOA, utilities, repairs, and commuting all count. If you're only budgeting the note, you're undercounting reality. Rule 3. Don't build a plan on appreciation. If appreciation happens, great. But if your purchase requires appreciation to be worth it, you're speculating. Rule 4. Choose liquidity. In uncertain times, the best asset is the one you can exit. Properties that are hard to insure, hard to finance, or uniquely expensive to maintain can trap you. The strongest position in a downturn is simple 1. Low leverage 2. High cash reserves 3. Stable income 4. A home you can carry comfortably 5. The ability to move without panic 6. The discipline to ignore hype, positive or negative, and focus on numbers because, in the end, housing isn't a debate. It's a contract, and contracts don't care how confident you feel. If you live in one of these metros, don't treat this as entertainment. Treat it as a prompt to tighten your position. If you're safe, you'll confirm it with math. If you're exposed, you'll see it in your monthly margin, your insurance risk, and your exit options. And if you don't know which one you are, that's the worst position to be in because markets punish uncertainty. This isn't about panic, it's about preparation. The people who win the next phase aren't the loudest. They're the ones who can hold steady while everyone else is forced to move. If you want the next step, focus on this. I can outline a clear checklist to assess your city and your personal risk, income stability, mortgage terms, insurance exposure, local inventory trends, and exit strategy so you're not guessing.